If you owe the IRS back taxes, here's something that might surprise you. The IRS doesn't have forever to collect. In fact, they only have 10 years. And understanding this deadline, which is called the Collection Statute Expiration Date, or also known as the CSED, this can completely change your strategy for dealing with tax debt. I'm Andrew Bosserman. I'm an IRS defense lawyer and former IRS agent. And today I'm going to explain how the 10-year collection statute works, when it makes sense to wait it out, and when you should pursue other resolution options instead. So let's start with the basics. Under Internal Revenue Code section 6502, the IRS has 10 years from the date your taxes are assessed to collect what you owe. After that 10-year window closes, they're legally barred from collecting the debt. It's written off and it disappears. Now, assessment is an important term here. Your taxes are assessed when the IRS processes your return, not when you file it or when the deadline passes. There's usually a delay of a few weeks between when you file and when the IRS actually processes and assesses the tax. And could be even longer if you file on paper versus electronic filing. But here's an example of how it works. So say you filed your 2024 tax return on April 15th, 2025, and you owe $10,000 that you can't pay. The IRS processes that return on May 5th, 2025. The 10-year collection statute now runs until May 5th, 2035. If they don't collect it by then, you're off the hook. But here's where it can get a little tricky. If the IRS audits you later and assesses additional taxes, that creates a new assessment date and a new 10-year period for that additional amount. So let's say you were audited in 2027 and the IRS assessed an additional $5,000. The 10-year clock on that additional amount would start ticking from the date they formally assessed it in 2027, not from when you originally filed in 2025. If it were as simple as just wait 10 years and the debt disappears, everyone would just attempt to wait it out. But the IRS has many collection options at their disposal, and there are also several events that can pause or extend that 10-year clock. First is bankruptcy. If you file for bankruptcy, the collection statute is paused for the entire length of your bankruptcy proceedings, plus an additional 6 months. So if your bankruptcy takes 2 years, you've just added 2.5 years to your collection statute for additional time for the IRS to collect if your tax debts don't end up getting discharged in bankruptcy. Second, requesting collection relief. When you ask the IRS for an installment agreement, submit an offer in compromise, or request a collection due process hearing, the statute is paused while they consider your request, plus 30 days after they make a decision. These pauses can add months or even years in some cases to the statute. And third, there's also other special circumstances. Being outside the United States for extended periods of time can toll or extend the statute. There are other situations too, which is why it's critical to have someone calculate your exact CSED if you're considering a waiting strategy. So the bottom line is that 10-year clock isn't as straightforward as it seems. Every time you interact with the IRS in certain ways, you might be giving them more time to collect your back taxes. So here's the big question and where the strategy comes into play. Should you wait out the statute or should you pursue a resolution? So if you're close to the statute expiring, say within a year or two, waiting it out might make sense. Why would you settle your debt for 50 cents on the dollar or whatever the amount is through an offer in compromise if the IRS only has 18 months left to collect anyways? In these situations, you might just want to keep your head down and avoid actions that extend the statute and attempt to let the time run out. Now, during this waiting period, the IRS can still take collection actions like filing liens or issuing levies, but if you can tolerate some potential pressure and don't do anything that extends the statute, you might walk away paying nothing. And plus, when certain collection actions happen, you get notified in advance from the IRS. It can always pursue resolution then. But say you have 5, 7, or 10 years left on the statute, that's a completely different story. Waiting out a decade of IRS collection activity is brutal and oftentimes impossible. They can levy your bank accounts, garnish your wages, potentially seize assets, and could make your life miserable for years. In these cases, you're much better off exploring resolution options. Your main resolution options include an offer in compromise. This is where you can sell your tax debt for less than you owe based on your ability to pay. This is a great option if you legitimately can't pay the full amount and your financial situation supports it. It is a very formulaic process. It's not as much of a negotiation as it might sound like or from other things you've heard on the internet. But if your financial situation supports it, it can be very powerful in getting your tax debt reduced. There are also installment agreements where you make monthly payments to the IRS. This includes what's known as a partial pay installment agreement. And that's where you can't afford monthly payments to pay off your debt before the 10-year statute expires. So the IRS will let you pay what you can afford. And when the CSED expires, and your remaining balance is forgiven. This is an excellent middle ground. You're making payments you can afford, but you're not paying the full amount. In bankruptcy can discharge certain tax debts if they meet specific criteria. Bankruptcy is, in my experience, particularly useful if you have old tax debt along with other debts that are crushing you financially. Each person's situation is different. So the key is understanding where you fall on that collection timeline and making an informed decision about whether time is your friend or your enemy and what resolution process fits you best. So how do you actually find out when your collection statute expires? First, you need your IRS transcripts. So generally, your IRS account transcript will show the CSED for each tax you owe, or if it doesn't, you can calculate it using the assessment date. So there are a number of different ways to get your transcripts. The easiest way is to log in to your online account on irs.gov and request them electronically. You can also get them by phone or fax or through a representative. So if you have a tax attorney, CPA, or enrolled agent representing you, they can pull transcripts on your behalf once you authorize them to do. But when you get your tax transcripts, if they have a CSED listed or a date listed, you don't necessarily want to trust that date blindly. The IRS can make mistakes. They might not have properly recorded certain events like bankruptcies, or might have miscalculated some sort of tolling period due to an installment agreement. So that's where having an experienced tax attorney review your transcripts is invaluable. Someone like me can verify that the CSED is calculated correctly and also might identify any errors that may be working against you, or maybe they're in your favor. So if you decide to wait out the statute, and actually before you decide to do, you need to understand the risks. So the first risk is that the IRS can potentially make your life difficult during that waiting period. While federal tax liens generally won't damage your credit score, they will often prevent you from borrowing against assets or refinancing property, and that could be something you might need to do for your situation. And levies can drain your bank account, or the IRS can also garnish your paycheck, so that could potentially leave you unable to pay your bills. The second risk is that you might accidentally extend the statute. If you request an installment agreement without realizing it adds time to the clock, or if you file for bankruptcy, you could be giving the IRS years of additional collection time. So before you do anything, you need to develop a plan. And the third risk, and this is an important one, the IRS can still assess additional penalties and interest while you wait. So penalties and interest oftentimes keep accruing until your balance is paid off. So even if you're hoping it will all disappear eventually, in the event that you have to get into resolution, the balance is likely going to keep inching higher due to continually accruing penalties and interest. So while waiting out the statute is a completely legitimate strategy, it's definitely not a passive one. You need to be strategic, informed, and have a plan for what the IRS might do during that time. So here's my advice in closing. If you owe back taxes, don't just hope for the best or hope everything works out smoothly. Get your transcripts, calculate your CSED, and understand your options. If you're within a couple of years of the statute expiring, it might make sense to tough it out and let time work to your advantage. But if you have a long road ahead, you're better off exploring some sort of alternative resolution option like an offer in compromise, a payment plan, or potentially even bankruptcy to resolve the debt on terms you can live with. And whatever you do, don't just make this decision by yourself. The collection statute is complicated, and one wrong move or miscalculation could potentially cost you years of additional collection time or thousands of dollars in lost opportunity. If you need help figuring out your CSED, evaluating your options, or protecting yourself from IRS collection actions, feel free to reach out to me at Boss Tax Law. As a former IRS agent and an IRS defense lawyer, I help people navigate exactly these kinds of situations every day. So thanks so much for watching, and I'll see you in the next video.